How did Buffett form his investment philosophy? What kind of companies does Buffett like to choose? And what mindset does Buffett follow when making investment transactions? This interpretation discusses The Warren Buffett Way, a book that introduces the investment methodology of the Oracle of Omaha, Warren Buffett. Before we dive in, please click on the subscribe button below to stay updated. Buffett is a well-known investor. In 2008, he became the world's richest person. His company, Berkshire Hathaway, ranks in the top 10 of the Fortune Global 500, with shares priced at $300,000 per share, making it the most expensive stock in the world. All of Buffett's wealth comes from investing. In the eyes of investors, Buffett is almost a godlike figure, and everyone hopes to learn his investment secrets. For example, tens of thousands of investors from around the world fly to the small town of Omaha, Nebraska, every year for the Berkshire Hathaway shareholders meeting, just to see Buffett in person. Omaha has a population of about 400,000. Another example is the famous Buffett charity lunch, where someone might spend millions of dollars for the chance to have lunch with him and listen to his teachings. This meal is just an ordinary steak, with a per capita cost of no more than $100. Why is Buffett so good at investing? Does he have any secrets? To uncover the mystery of Buffett's investments, hundreds of books have been published domestically and internationally. Among them, The Warren Buffett Way is considered the best summary of Buffett's investment philosophy. This book reviews the formation of Buffett's investment style, analyzes Buffett's classic investment cases over 60 years, and summarizes Buffett's stock-picking methods into 4 major investment principles. Additionally, the book introduces Buffett's criteria for selecting people, managing emotions, and thinking methods in investment decisions, which are applicable far beyond the investment field. Legendary fund manager Peter Lynch said, "This book contains the thoughts and philosophy of a successful investor. Its methods are worth practicing for anyone of any financial level." The author, Robert Hagstrom, is a fund manager who is adept at researching and writing about the ideas of Buffett and Munger. His works, including The Warren Buffett Way, The Warren Buffett Portfolio, and The Wisdom of Charlie Munger, are classics in the investment field. The book posits that while ordinary people using Buffett's methods may not become billionaires, they will certainly improve their long-term investment level and become better investors. I will discuss 3 key points. The road to becoming a legendary investor. How did Buffett form his investment philosophy? The stock-picking strategy. What kind of companies does Buffett like to choose? The buying and selling strategy. What mindset does Buffett follow when making investment transactions? Part 1. The road to becoming a legendary investor. Buffett was born in Omaha in 1930. From a young age, he was obsessed with numbers and money, buying his first stock at age 11. To uncover the secrets of investing, young Buffett read every book on stocks in the library and drew stock charts himself, but after several years, his level was not much different from that of an ordinary small investor today. So, how did Buffett later form his investment style? He was mainly influenced by 3 people: Benjamin Graham, Philip Fisher, and Charlie Munger. Let's introduce them one by one. The first is Benjamin Graham. We are also familiar with Graham. He was Buffett's teacher at Columbia Business School and the founder of the securities analysis industry, known as the father of value investing. He wrote 2 books, Security Analysis and The Intelligent Investor, with security analysis being called the Bible of investing. Buffett was not yet 20 years old when he saw these 2 books. He realized the true meaning of investing and systematically learned value investing theory under Graham. Graham's value investing philosophy, which significantly influenced Buffett, mainly consists of 3 points. Buying stocks means buying companies, buying stocks at a discount, and how to view market fluctuations. Buying stocks means buying companies. Young Buffett, like most investors, initially saw stocks as mere pieces of paper with prices, but after meeting Graham, he realized that stocks represent real companies. Whether buying 100%, 10%, or just one share, it represents a corresponding portion of the company. Many traders focus too much on stock price fluctuations and forget the true meaning of stocks. Buying stocks at a discount. You may have heard this investment saying, Rule number 1, never lose money. Rule number 2, never forget rule number 1. This originally came from Graham. To avoid losing money, Graham's method is to buy stocks at prices much lower than their value. A company has an approximate real value, determined by its assets, profits, dividends, and future prospects. If the stock price is significantly lower than this real value, investors will be relatively safe after buying in. Even if they are wrong, there is room for error, making it less likely to lose money. How to view market fluctuations. Graham created a parable character called Mr. Market who offers a daily price for stocks to investors. However, Mr. Market's mood is unstable, sometimes optimistic, sometimes pessimistic, resulting in fluctuating prices. But the real value of the company the stock represents does not fluctuate drastically every day. Investors should remain rational, ignoring or taking advantage of opportunities Mr. Market brings. Thanks to these 3 key points learned from Graham, Buffett's early investment career was very successful, and the private fund he managed grew rapidly. However, as the capital grew, he also discovered a problem with Graham's method. It focused more on price rather than quality. The companies bought often had operational difficulties and uncertain prospects, requiring Buffett to figure out how to bankrupt them to liquidate assets and recover money. At this point, Buffett's investment style gradually shifted towards the second person, Philip Fisher. Like Graham, Fisher was also a value investor, but their stock-picking styles were completely different. Graham emphasized the cheapness of the company, while Fisher focused more on the company's growth potential, preferring to buy good companies and growth stocks at reasonable prices. For example, Graham would buy something worth $1 for 50 cents, while Fisher would spend $1 to buy something that would be worth $10 in a few years. To find such a future valuable company, Fisher emphasized 2 points: buying good companies and choosing good management. Therefore, Fisher's research methods also differed from Graham's. Graham preferred quantitative analysis of financial statements, even suggesting investors shouldn't meet company executives to avoid being influenced. In contrast, Fisher preferred qualitative research, advocating for investors to investigate and observe the company's management. Fisher particularly valued a company's competitive moat, later referred to by Buffett as the moat. Buffett encountered Fisher's theories early and recognized their validity, but it was the third person, Charlie Munger, who helped him break free from his old thinking and transform his investment style. Munger was both a partner and mentor to Buffett. Munger's main influences on Buffett were twofold: paying for quality and adopting a multidisciplinary approach to arm his mind with knowledge from various fields. In Munger's view, paying a fair price for a great company is better than paying a low price for a mediocre one. Under Munger's influence, Buffett moved beyond Graham's theory. In 1971, Munger convinced Buffett to buy See's Candies at 2.5 times its net asset value. Previously, Buffett wouldn't even consider paying 1 times the net asset value. This was the first time in Buffett's investment career that he paid for quality. See's Candies later became one of Buffett's most successful investments, and he still holds the company today. In 1978, Munger and Buffett's investment companies merged, and they officially became partners, building the world's largest investment empire together. Each year at the Berkshire Hathaway shareholders meeting, the 2 old gentlemen sit on stage for hours answering various questions from shareholders, an annual spectacle in the investment world. Now we know that Munger is not just Buffett's partner, but also a big thinker with multidisciplinary wisdom. Munger has delved into various knowledge fields, including science, history, philosophy, psychology, and mathematics, applying these to investment decisions and all aspects of life. If you're interested, you can find the book Poor Charlie's Almanac on the Daily Book Dive channel to learn more. This concludes the first key question, reviewing Buffett's path to becoming an investment legend. He learned from Graham that buying stocks means buying companies, understood from Fisher that buying growth stocks is more valuable than buying cheap stocks, and partnered with Munger to start paying for quality, gradually forming his unique investment system. Part 2. The stock picking strategy. Next, let's discuss the second question. How does Buffett choose stocks? Although Buffett is nicknamed the Oracle of Omaha, he doesn't speculate in stocks but invests in companies. Buffett believes that buying an entire business and buying part of a company's stock is essentially the same. Therefore, when making investment decisions, Buffett analyzes companies, not markets, macroeconomics, or stocks. The book summarizes Buffett's investment method into 12 principles, which I have condensed into 4 parts, calling it the 4 Good Company Standards. Business principles. Is the business good? Management principles. Are the executives good? Financial principles. Is the return good? Market principles. Is the stock price good? Buffett's favorite drink is Coca-Cola, and it is also one of his most famous investment cases. Let's use the Coca-Cola case to specifically look at what constitutes a 4 good company. First, is the business good? Buffett's preferred companies meet 3 criteria: a simple business model, a long and stable operating history, and clear long-term prospects. He also introduced the term moat, which refers to a long-term sustainable competitive advantage that can resist competitors. The wider the moat, the stronger the sustainability, and the more Buffett likes it. The book lists 9 of Buffett's classic investment cases, including Coca-Cola, Heinz, Wells Fargo, and American Express. These companies are not only well known in the US but also globally renowned. Moreover, these companies are closely related to people's lives, providing the same products and services for decades, with extensive financial data available and clear future development directions. For example, Coca-Cola has been selling syrup beverages for the past century and will likely continue to sell beverages for the next century, with people worldwide still drinking it and the company's profit margins remaining high. Such a business is understandable and good. Second, are the executives good? Buffett once said he likes to buy businesses that even an idiot can run. The exact words were, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Does this mean that management is not important? Not at all. Even a business that an idiot can run cannot withstand a spendthrift's mismanagement. Throughout Buffett's investment career, he has never bought a business without good management, no matter how good it is. So, what constitutes good management? Buffett believes that the best management should behave and think from the perspective of the company's owner, maximizing shareholder value. Specifically, Buffett has 3 requirements for management: rationality, honesty, and independent thinking. Rationality means efficiently allocating resources. Honesty means reporting both good and bad news and admitting mistakes and failures. Independent thinking means not following the crowd. The first 2 points are easy to understand. The third point, independent thinking, is a quality that most company executives lack. Most company management tends to overestimate their abilities, have idle hands, and like to imitate their industry peers. If others invest in new projects, they want to follow suit. If others expand overseas, they also want to expand overseas. If others grow by 20% in a quarter, they dare not report less than 19%. Conformity is rooted in human nature. It feels strange and awkward not to follow what others do. but a good manager should avoid following the crowd. Let's use Coca-Cola as an example. This century-old company has always been a good business. But why did Buffett buy it in 1988 and not earlier or later? He said it was the change in Coca-Cola's leadership that attracted him. Throughout the 1970s, Coca-Cola was plagued with troubles, faced numerous lawsuits, and saw a sharp decline in operating performance and profit margins, with its stock price lagging behind the S&P 500 index. Why? Because the leadership was incompetent. At the time, Chairman Paul Austin was autocratic, blindly expanding to maintain revenue growth, and bought many unrelated and unprofitable businesses, including a failing winery and investments in water projects and shrimp farms. Yes, shrimp farming and water. In 1980, Coca-Cola replaced its leadership, appointing new chairmen and presidents. The changes were significant. The new management sold off unrelated businesses and refocused on the company's core business, selling syrup beverages. They also cut costs and clarified the company's core goal, increasing profitability. How can you judge whether management is doing well? Buffett provides some tips. You can look through the company's annual reports for the past few years. Especially carefully read the management statements about future strategies and compare them to reality to see if they have delivered. Besides this, you can check the financial data. Financial data is the third factor in evaluating a for-good company. From a financial perspective, is the return to shareholders good? What financial data should you look at? First, check if the company is profitable. Buffett focuses not on net profit but on profit margins and return on equity, ROE, which reflect how much money is made for every dollar of sales or capital invested. These indicators truly reflect the company's long-term profitability. Next, see if the company returns profits to investors. Buffett created a metric called the $1 principle, which means that for every dollar of profit retained within the company, it should at least create $1 of market value. Management's most important job is to allocate profits. Whether it's raising employees' salaries or investing in research and development, the part of the profit not distributed to shareholders must increase in value, or it is irresponsible to investors. Using Coca-Cola as an example again, we mentioned that Coca-Cola changed its leadership in 1980. How did they perform? The data speaks for itself. In 1980, Coca-Cola's pre-tax profit margin was as low as 12.9%. By 1988, the year Buffett bought in, the profit margin had risen to a record 19%. During the same period, Coca-Cola's market value grew at nearly 20%. In other words, every dollar retained by the company created $5 of market value. Coca-Cola's leadership change had an immediate effect, and Buffett's decision to buy in was based on its good returns. Good business, good management, and good returns make a dream company for investors. But even the best things can't be bought at too high a price. This is Buffett's fourth principle. Is the stock price good? To buy at a discount, you first need to determine how much the business is worth. How do you calculate this? It's like investing in a shop or a small business. You estimate how much you want to earn annually and how many years it will take to recover your investment. For a company, you consider more factors: its longevity, annual investment, net earnings, changes in its main business, and other investment opportunities during the same period. Buffett emphasizes that it is better to be roughly right than precisely wrong. Calculating down to decimal points is useless. What's important is understanding the company and roughly estimating its long-term returns. According to the author's calculations, when Buffett invested, Coca-Cola's market value was about $15 billion, and its true value was between $20 billion and $48 billion. Even with the most conservative estimate, Buffett bought Coca-Cola stock at a 30% discount. In another case, Buffett bought Washington Post stock at an extremely low price of 20 cents on the dollar. How did these investments perform? Coca-Cola's value increased tenfold in 10 years, and Washington Post's value increased 36 times in 20 years, with annualized returns exceeding 20%, making them classic cases in Buffett's investment portfolio. To summarize, we just discussed Buffett's 4 good criteria for choosing companies: good business, good management, good returns, and good price, with all 4 elements being indispensable. Part 3. The buying and selling strategy. Now, let's address the third question. What mindset does Buffett follow when making investment transactions? Buffett's stock-picking methods are not mysterious. To choose a good company, it must have a good business model, good management, good financial data, and be bought at a good price. This method is not only easy for Wall Street elites, but also for ordinary people to operate. But what's the reality? In the US, buying Coca-Cola stock might be the easiest investment. Coca-Cola is almost a symbol of the US, with nearly every American having drunk it, and its stock was listed as early as 1919. In the late 1990s, the author of this book attended many investment seminars and always asked the audience, "Who has held Coca-Cola stock in the past 10 years?" Almost everyone raised their hands. He then asked, "Who has achieved the same return as Buffett?" All the hands went down. Why didn't others make as much money as Buffett from buying Coca-Cola stock? In investing, knowledge only answers what to buy, while psychological preparation determines how to act. Let's focus on 3 key mindsets that are crucial to Buffett's investment transactions: the circle of competence, probability thinking, and contrarian thinking. Circle of competence. The circle of competence refers to the range of one's abilities. Buffett has always emphasized investing within one circle of competence. In other words, to increase your success rate, do low-difficulty tasks and avoid doing things you can't handle. In investing, most people like to chase new concepts and trends. At every stage, there are always hot stocks in the market with significant short-term gains. But Buffett almost never pays attention to hot stocks. Others focus on what will change in the future, while Buffett focuses on what won't change. You've certainly heard that Buffett rarely buys tech companies, often criticized for being out of touch and falling behind the times. But Buffett has his reasons. The tech industry changes too quickly, and the competitive advantages of giants can collapse in an instant. To him, this is having no moat. Although some internet and high-tech companies have astounding returns, the overall failure probability and difficulty of selection are much higher. In contrast, Buffett prefers to buy companies that make sugar water and chocolate, products that haven't changed for a century. Of course, in recent years, Buffett has also invested in tech-related companies like IBM and Apple, but when buying, he valued their long-term competitive advantages and monopoly positions. IBM provides IT system services, and Apple is more like a consumer products company. It's worth noting that in the 9 cases provided in the book, IBM is the only one with less ideal returns. Buffett cleared his IBM holdings in 2018 and admitted his mistake in multiple occasions. This reinforces that even the Oracle of Omaha can fail when stepping out of his circle of competence. Probability thinking. This means taking heavy bets on great opportunities. In essence, investors face a probability puzzle. The stock market is a warehouse filled with various possibilities, where different forces collectively influence stock price changes. Investors need to judge the probability of various events and make investment decisions accordingly. The other side of probability is odds, the return ratio given by gambling companies based on the probability of events occurring. Generally, odds align with the real-world probabilities of events, but sometimes unreasonable odds appear. For example, in horse racing, a horse with a half probability of winning may have odds of 1 to 10, meaning a tenfold return. The stock market is similar. Investors must have probability thinking to make big money. Find mispriced stocks, seldom bet, but place heavy bets on excellent opportunities. Since great opportunities that you understand and can grasp are rare, Buffett's analogy is apt. If you should use a big bucket to collect money, don't use a small spoon. You've likely heard the phrase, "Don't put all your eggs in one basket," meaning diversify investments to reduce risk. On Wall Street, where diversified investment strategies are popular, many fund managers frequently buy and sell large numbers of different stocks. A fund may hold hundreds or even thousands of stocks, each accounting for at most a few percent of the portfolio. Buffett's view is the opposite. Put all your eggs in one basket and then watch that basket carefully. Traditional diversification strategies may involve buying many things you don't understand, greatly increasing the chances of making mistakes. Buffett's concentrated investment is quite different. He prefers holding a few high-quality companies' stocks over many mediocre ones. From 1988 to 1989, Buffett spent $1 billion to buy Coca-Cola stock, making up more than a third of his portfolio. In 2018, Buffett controlled nearly $200 billion, with two-thirds concentrated in just 5 stocks. For such a vast investment empire, this level of concentration is unimaginable. Yet, this strategy proved correct, with most of Buffett's wealth coming from a handful of investments. Contrarian thinking. Buffett's famous saying might be fearful when others are greedy and greedy when others are fearful. Most people have a herd mentality, especially in the stock market, leading to buying at high prices and selling at low prices, which is why they lose money. Buffett is skilled at contrarian investing, but being different alone isn't enough. You must understand why others are wrong, know what you should do, and have the inner strength to stick it out until you win. For example, what do you do when stock prices fall? Most investors can't bear the pain of falling stock prices. In some stock markets, selling losing stocks is called cutting meat, vividly describing the pain. On Wall Street, most traders use stop-loss strategies, selling stocks when losses reach a certain percentage to prevent further losses. But Buffett is different. He isn't afraid of falling stock prices. Instead, he sees them as buying opportunities. In Buffett's dictionary, stop-loss doesn't exist. He doesn't need stock prices to prove he's right. He uses time to prove he's right. While most people try to make the most money in the shortest time, Buffett waits for good opportunities and good companies to bring him enormous returns. Patiently waiting is painful. Immediate action and immediate results align with human nature. But Buffett's long-term approach, resisting greed and fear, makes him the winner. Statistics show that the longer the time frame, the more stock returns align with the company's business and profitability levels. In other words, Buffett's long-term investment is the core of his success. To summarize, this book discusses the reasons behind Buffett's success through 3 key points. Buffett's road to becoming an investment legend. We reviewed how Buffett formed his investment philosophy, mainly influenced by 3 people: Graham, Fisher, and Munger. He learned from Graham that buying stocks means buying companies, understood from Fisher the importance of company quality, and was influenced by Munger to start paying for quality. Buffett's stock-picking strategy. Through the Coca-Cola case, we learned Buffett's 4 criteria for choosing companies: good business, good management, good returns, and good price. Buffett's buying and selling strategy. We focused on 3 mindsets crucial to Buffett's investments: the circle of competence, probability thinking, and contrarian thinking. Successful investing requires not only knowledge but also psychological preparation. That's the essence of this book. The original book link is attached at the end for further reading. You can also click the share button below the video to share this book with your friends. Congratulations, you've just finished another book.